Good afternoon, dear traders. So, not long ago, while discussing US dollar against Japanese yen, I mentioned that, in my opinion, the area above 160 represents an extremely dangerous zone for dollar buyers. This is where the probability of intervention by the Japanese authorities increases dramatically. As recent events have shown, that scenario has indeed played out. After the pair climbed toward 163.5, the yen strengthened sharply. According to market reports, this was one of the largest coordinated currency operations in decades. The intervention appears to have been supported not only by the Japanese authorities but also by the United States. For Washington, this can be viewed as a demonstration of support for one of its key allies, while for Japan, it's provided an opportunity to stabilize the exchange rate without resorting to a more aggressive increase in interest rates. What happened next made the situation even more interesting. The very next day, the Bank of Japan held its monetary policy meeting, and many market participants expected that such a large-scale intervention would be followed by an interest rate hike. However, that did not happen. The Bank of Japan left its policy rate unchanged at 1%, while limiting itself to more hawkish language, reiterating that further tightening remains possible if economic conditions evolve as expected. This naturally raises an important question. If policymakers are truly concerned about the weakness of the yen, why not raise interest rate now? In my view, the answer lies in the condition of Japan's economy. Tightening monetary policy too aggressively could do more harm than a weaker currency. Economic growth remains fragile, and high borrowing costs could significantly slow domestic activity. For that reason, Japanese authorities appear to prefer maintaining accommodative monetary conditions while using foreign exchange intervention as an additional tool to stabilize the currency. Meanwhile, their broader fundamental picture has changed very little. The Federal Reserve policy rate remains at 3.75%, while the Bank of Japan stands at 1%. The nearly 2.75 percentage point interest rate differential continues to support carry trades where investors borrow low yielding yen to invest in higher yielding US dollar assets. That remains one of the strongest fundamental drivers supporting the dollar against the yen. Now, another interesting possibility emerges. The market has become accustomed to believing that Japanese authority only intervene once the US dollar against Japanese yen moves well above 160, and only above this area it can be possible. But what if policymakers decide to change that psychology altogether? The pair is now trading much lower, around 157, 158, and it's a global and very strong level. So we can see it through weekly chart, through daily chart, and we can see it through even local charts. So I think maybe I would not rule out the possibility that another intervention could occur from these levels. Perhaps that sounds a little like a financial detective story, but it is certainly not impossible. The goal of a successful intervention is not only to influence the exchange rate, but also to reshape market expectations. If investors begin to believe that intervention can occur not only above 160, but also well below that level, the willingness to aggressively pursue carry trades could diminish significantly. From a technical perspective, the chart has become particularly interesting. Despite the sharp correction following the intervention, the broader long-term trend remains bullish. The 157-160 area has now become the key battleground. This is where the market will decide whether the intervention was merely a temporary interruption of the uptrend or the beginning of a genuine shift in market expectations. For now, however, the fundamental advantage still favors the US dollar. The difference is that market participants must now consider not only the interest rate differential, but also the risks and ever presented risk of another unexpected intervention by Japan's financial authorities.